All right, welcome back to The Explainer. Today, we're tackling a really fascinating challenge. We are going to run a high-growth, next-generation space tech stock right through the unforgiving gauntlet of classic value investing frameworks. The subject? BlackSky Technology, trading under the ticker BKSY. It's a company literally capturing real-time satellite imagery from low Earth orbit. But the big question we want to answer is, how does a futuristic business like this actually hold up when we apply the old-school, time-tested methodologies of Warren Buffett, Peter Lynch, Benjamin Graham, alongside some modern valuation models? Let's get right into it. Okay, here is our game plan for today. We'll kick things off with a quick company snapshot, then view the stock through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll dive into some valuation models, and finally bring the whole shebang together with a clear synthesis and recommendation. Starting off with Section 1, the company snapshot. Before we start crunching the numbers, let's understand what BlackSky actually does. Basically, BlackSky is in the business of selling real-time truth from space. They operate this incredibly advanced proprietary constellation of low Earth orbit satellites. What's really driving their momentum right now is their Gen-3 satellite deployment. We are talking about mind-blowing 35-centimeter imagery resolution. Then, they layer that hardware with high-margin AI subscription services that boast gross margins near 80%, which is just huge. And, the market is definitely paying attention. They recently locked in up to $160 million in new contracts, inflating their backlog to a massive $380 million. Top-line-wise, the story is absolutely phenomenal. But here's where things get real. Contrast that futuristic tech with their current, hard financial reality. With the stock trading around $25 a share, giving them a market cap of roughly $903.5 million, the company's in a massive capital expenditure phase. They are carrying right around $210 million in debt against just $115 million in cash. It's your classic high-tech setup. Unbelievable potential, but a balance sheet that is just groaning under the sheer cost of building out a global satellite network. So what does this mean for us? It means we're looking at a high-risk, high-reward scenario right out of the gate. Moving right along to Section 2, the Warren Buffett lens. We're looking for moats and reliable owner earnings here. Now, if we systematically run through Buffett's criteria, it's kind of a mixed bag. On the plus side, BlackSky absolutely possesses a strong economic moat. Building a space-based, AI-integrated constellation from scratch, that is ridiculously difficult and capital-intensive, which easily keeps casual competitors completely out of the picture. Plus, management is executing well. They just raised their full-year 2026 revenue guidance to somewhere between $130 and $150 million. But Buffett demands consistent earnings and a high return on equity. And here, BlackSky completely fails. They simply aren't profitable at the operating income level, and they are bleeding ongoing net losses. Just to put a really fine point on it, their last 12 months' net income is sitting at a deeply negative $87.1 million. Now, in Buffett's world, we calculate what he calls owner earnings to figure out the actual cash a business generates for its owners. When you factor in the massive capital expenditures, they're expecting to spend $50 to $60 million in 2026 alone, and combine that with negative net income, BlackSky's owner earnings aren't just missing, they are profoundly negative. And we all know Buffett's famous rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. For the Oracle of Omaha, this lack of consistent profitability and negative cash flow is just an absolute deal breaker. Without predictable earnings to discount back to the present, trying to establish an intrinsic value with a proper margin of safety is, well, it's impossible. At current prices, Buffett's methodology would aggressively trigger a hard avoid until that cash flow turns green. So if you're running a conservative portfolio, this is a very clear pass. All right, Section 3, the Peter Lynch lens. Here, we're weighing explosive growth against profitability.
Now, Lynch is famous for being way more forgiving of young companies, as long as the growth story makes logical sense. And under his framework, BlackSky is a textbook fast grower. Look at this. They have projected sales growth of nearly 40% in fiscal 2026, and over 32% projected for 2027. That is phenomenal top-line expansion. But we run into a major snag. Lynch's absolute favorite metric for valuing these fast growers is the PEG ratio. Price to earnings divided by the growth rate. But because BlackSky's PE ratio is negative 10.4, calculating a meaningful PEG ratio is literally a mathematical impossibility. You just can't divide a negative PE by a growth rate and get anything useful.
And this brilliantly illustrates the ultimate Lynch dilemma. You have this towering, impressive projected revenue of $136.5 million for 2026, but it is directly offset by a severe projected net income loss of roughly $50 million bucks. Lynch loves a great understandable product, and space-based AI definitely fits the bill. But this severe cash burn would almost certainly push him into a cautious hold position. He'd want to sit on the sidelines and wait to see profitability actually start catching up to that 39% growth rate before jumping in.
Let's move to Section 4, the Benjamin Graham lens. Time for the strict defensive investor test.
Okay, so when we put BlackSky through Graham's famously strict defensive investor checklist, you see exactly how brutally a modern, unprofitable tech stock gets treated by these old-school conservative metrics. It does pass on adequate size with that $903 million market cap, but it fails on strong financial condition because of liquidity risks. It fails earnings stability because, again, consistent net losses. Dividend record fails, it pays zero dividends. Moderate PE and PB fails because of the negative PE. It's essentially a rapid-fire succession of red flags for a traditional value investor. And it honestly gets even more stark when we apply Graham's explicit intrinsic value formula. The formula is the square root of 22.5 times earnings per share times book value per share. So if we plug in BlackSky's projected fiscal 2026 EPS at negative $1.48, you are mathematically forced to take the square root of a negative number. It literally generates a calculator error. Graham demands a margin of safety based on hard, current assets and historical earnings, not future speculative space contracts. For Graham, there is no debate here. This is an automatic, unequivocal avoid. On to Section 5, Valuation Models. Since the classic gurus are struggling here, let's look at DCF and comparables. So, building a standard base case discounted cash flow model for BlackSky is incredibly tricky. When you have a 3-year average free cash flow yield of negative 5.1%, trying to anchor a terminal value using the perpetual growth method becomes wildly speculative. The tiniest tweak in your weighted average cost of capital assumption swings the fair value all over the map. However, if we pivot and look at external fair value models, like the one from Simply Wall Street, which leans heavily into the narrative of successful Gen-3 adoption and contract momentum, they peg the fair value right at $40.50. If you buy into that model, it implies the stock is currently trading at a massive 57% intrinsic discount. Now, let's check out the comparable multiples. BlackSky is currently trading at a price-to-sales multiple of 9.2x. If you compare that to its direct high-profile space competitor, Planet Labs, which trades at an eye-watering 27.9x, BlackSky actually looks like a relative bargain. But let's zoom out for a second. When you look at established geospatial players like Trimble sitting at 3.2x or the broader sector average of just 1.9x, reality kind of sets in. That massive leap from a 1.9x industry average all the way up to 9.2x shows you exactly how much of a premium the market is placing on BlackSky's future growth narrative. And finally, Section 6, Synthesis and Recommendation. Let's get to our final verdict. So, here is the crucial point. We've got wildly conflicting signals. Warren Buffett, he says, avoid it until you see consistent positive owner earnings. Peter Lynch says, hold, wait for the profitability to actually validate that massive top-line growth. Benjamin Graham says avoid entirely because his intrinsic value formula literally breaks. Meanwhile, the market and narrative-based valuation models suggest a speculative buy, dangling a massive upside target of $40.50. It's the classic standoff. Extreme top-line growth clashing head-on with heavy cash burn and absolutely zero classic value support. Ultimately, you have to weigh this incredible technology. Real-time AI monitoring from space and a $380 million backlog against some glaring financial risks, including a really harsh 51% drop in return over a recent one-month period. If you truly believe those Gen-3 satellites will seamlessly convert government pilot programs into highly profitable recurring subscriptions, then yeah, that 40/50 target is totally within reach. But if execution falters even a little bit, that cash burn is going to drag the share price down fast. Which brings us to our final thought for today. As we analyze these wild new frontier companies, we really have to ask ourselves, are traditional value investing metrics fundamentally broken when we're evaluating the economics of the new space age? Or are they the exact things protecting us from taking astronomical losses on really cool technology that just hasn't figured out how to make a profit yet? It's a lot to think about. Thank you so much for joining me on this deep dive into the numbers, and I'll catch you in the next explainer.